Hello. Rahil, am I audible?
Yes, Pratik, you are.
Yes. So, yes, thank you, Agustin. So, good afternoon, partners. So, just let me welcome you to the webinar session on the leverage product. I am Pratik Jain and I head the products for the digital well business of Anand Rathi. And today we have Rahil Manyar. So, he's part of the Anand Rathi Wealth Group and he's the one who's actually looking after the leverage product. So, we actually invited Rahil only to take us through this important piece which we've been sharing with the partners also in various notes where the strategy is 65, 35, 20. So what is 20? I think so is something which we've had a very brief discussion with the partners. So we thought we can just actually have a detailed discussion on what is this 20 and what this leverage can basically add to the overall proposition. So that's why we have Rahil. Rahil has more than 8 years of work experience with Anand Rathi. So he's been there in Anand Rathi since a long time. So welcome, Rahil. And we have all the partners who joined us today for this webinar who worked with us. So the session, of course, the topic is the leverage product, and Rahil will cover the leverage product also. Explain why this was introduced and what it actually does to the overall portfolio and the proposition, and a bit on the documentation part as well, that how this is executed, and then we'll open the floor for questions. So welcome, Rahil, and over to you.
Thank you so much, Pratik. Hi, everyone. Very good afternoon. So, like Pratik rightly mentioned, what we'll do is we will talk about the leverage strategy, right? So, I have a very small presentation that I have made. We'll go through that presentation. Along with that, I'll explain you the complete strategy. Right. So, to start off with, the first part of the presentation is what is this leverage strategy and where are we coming from in terms of using this leverage as a strategy, right? Uh, so, yeah. So the first slide talks about understanding the debt equity ratio. Uh, Let me put it this way. Leverage as a strategy is not something new today, right? It's not a new product or it's not a new innovation that we have come in and giving our clients. It is a concept or a principle of finance which is very commonly used in corporate world or businesses. But when it comes to personal finance, we usually tend to be averse of this, principle of finance. How so? Let's say if there's a company, let's say there are two individuals who wants to start business. They have to infuse their capital, put it into the business, put it into operation, make some profits, plow back the profits, right, and grow the business accordingly. But let's say there's a second individual who wants to start his own business but lacks capital. Naturally, what he'll do is he'll borrow that capital either from his relatives, friends, banks, institutions, etc. Right? Pump into the business, put it into operation, make some profits, and plow back the profits. Keep the profits with himself and give that borrowed capital back over a period of time. Right? So, what did the second individual do? He levered over someone else's capital in order to make some profits for himself. Right? That is what is a very common practice in today's corporate world as well. Having said which, if you pick up any listed entity today, if you open the balance sheet of an entity, right? Balance sheet comprises of two portions. One is liability, one is assets. On the liability side of the balance sheet, you'll see equity. Along with that equity, you'll also see debt. What is that debt? Again, that debt is the same money that they have borrowed from outside. They've pumped into the business to put into their operation and make some profit out of it. So this practice is very rigorously and commonly used in businesses and corporates. But when it comes to personal finance, right, one tends to be averse of this strategy, saying that, hey, I have 100 rupees today that I'm going to invest. I'm not going to think of 110, 120, or 130 today, right? As and when I get, I'll keep on investing in, right? So what we are trying to say is, even in personal finance, there are two legs. One is for consumption, second is for long term, right? As an individual, one usually tend to do leveraging for consumption. And a very common example is when somebody is either purchasing a car or somebody purchasing a property, right? If you have a cash, you pay upfront cash to take that, you buy that car. But if you don't have that cash, what you do is the first thing, you go to a bank, you take a car loan, which means you're applying the same principle of finance. You are borrowing and now you are consuming. You've bought that car. Now, car is classified as an asset, but car is classified as a depreciating asset. So today, if you buy a 25 lakh rupees car, let's say after 2 years you sell that particular car, you're not going to get 30 lakhs out of it, right? So point being made, you don't leverage for consumption. What we are suggesting is leveraging for investment. That is where we are coming from, using this particular strategy of leveraging into portfolio management, right? So likewise, I have so many examples. Like I said, property. A very classic example or very simple example is a credit card, right? When you swipe a credit card, you're actually borrowing money from bank and you are consuming it, right? So again, that's a leverage. So point again, second point is overutilization of leverage is something for consumption is a complete no-no, right? That is where this concept of debt equity ratio also comes into play, where we are saying equity is your owner's own money, debt refers to your borrowed money, and total capital is equity plus debt. So option 1 and option 2, there are two options. Let's say equity is 100, which is our own money. You don't borrow anything. You have total capital of 100, right? So your debt equity ratio is anyways going to be 0. That 100 rupee grows at 14%. So profit before interest will be 14. Zero interest cost. So profit after interest is also 14, which means the return on equity of that 100 rupees is 14%. How did I come to 14%? 14 divided by the own money, which is 100. In the second option, we have 100 rupee as our own money, which is equity. You borrow 20 rupees, right? So total capital to be deployed is 120. Now my debt equity ratio is how much? 0.2x. How 0.2x? 20 divided by 100 is 0.2. Now the whole 120 is going to grow at 14%, which is going to make me a profit of 16.8 rupees, right? But I had borrowed 20, so there's a cost involved. So the cost is 1.8. If I exclude the cost, the net return is 15. So profit after interest is 15. Now if I compute my return on equity is 15 divided by my own money, which is equity, which is 15%. So by having that 20% leverage, it can increase the IRR by 1%. Right? So this is what the leverage strategy is. Right? Now we have defined that leverage strategy in very simple terms. If I have to say, it's nothing but borrowing and investing. That is what the strategy is. But when we talk about borrowing and investing, there are three key principles that we keep in mind. Right? Principle number 1, there has to be substantial difference between the potential return and the cost of borrowing. Yeah, it's a common sense, but it has to be substantial enough in terms of this strategy to be successful or lucrative enough to for a client to accept it. Let's say today you're borrowing at 9%, you're deploying the money at 10%. Difference is 1%. Why would somebody do so much for just 1% differential? Not worth looking at. But if let's say somebody is borrowing at 9%, investing at 15%, difference is 6%, right? So the 6% spread is decent spread, because in value terms, if I were to talk about it in a gist, 1.1 crore invested or leveraged will become 2.29 crores over a period of how much ever tenure the strategy is. 52 lakhs will be your total interest cost and 67 lakhs is the net profit that we end up making, right? So point being made, there has to be substantial difference between the cost that you're paying and the return that you are making, right? That's my principle number 1. Principle number 2 is that if at all you're looking at the spread, if at all you're looking at a spread of that 6%, what are the odds? What are the chances? What is the probability of you earning that 6% spread, right? So high probability of successful outcome is the second principle that we want to follow. Again, not looking at this number, but if I were to just give you an example, put some numbers again into perspective for this thing is, as you know, there are various instruments that we offer to our clients. Let's say equity mutual funds, PMS, structured products, XYZ. Now, I'm just taking equity mutual funds as an example. To earn 15% return in an equity mutual fund, subconsciously, you also expect market to grow by at least 11-12%. With that 3-4% alpha, you will make it at 14-15%, right? But in last 25 years, if I were to see how many times has actually market grown by 12% or more? The outcome was 54% of the time. So that's one leg. On the other hand, we have structures. Structures, as you all know, are lesser dependent on the market. It's non-linear to markets. It says if market grows by 6-7%, you still end up making 14-15%. Again, same 25 years data set. If I see how many times has market grown by 6% or more, the outcome was 84% of the time or 80% of the time. Right? So hands down, I'm going to choose structured product as the tool or the product that we're going to invest in this strategy, right? Which has a high probability of successful outcome, right? So if I have to again redefine the strategy, is nothing but we are leveraging and investing into a structured product, right? And these are the scenarios of the same strategy. Return on investment being higher than the cost of borrowing, which is a success ratio, is 80%. Return on investment being equal or higher, because there's a cost involved, there has to be a break-even level also involved over here. When do you break even, or how many times do you break even? 92% is the probability that you break even. And return on investment being lower than the cost of borrowing. This is a scenario where you incur a loss, is about 8%. So this is my second key principle of leveraging. A third one is nothing but how much one should do. What is the extent of leverage one should have? Obviously, one has 100 rupees, they can borrow another 100 rupees and pump into it, right? Your debt equity ratio becomes 1. Your spread will also increase accordingly. But the point being made, leverage ratio has a direct correlation to the output of the strategy. Higher the leverage, higher the return, but higher the risk as well. And vice versa. What we are doing is, as a house, we are restricting ourselves to not more than 20%. Why am I saying 20%? Is that this, let's say if this 20% works in our favor, my spread was 6%. First principle, my spread was 6%. 20% is the exposure. If that works in my favor, 20 into 6 is nothing but 1.2. So on the overall portfolio, whatever a core cash investment is growing, over and above that, your 1.2% is what this 20% can give you. So let's say if you're growing at 14%, you can go as high as 15.2% on the portfolio level. If this 20% doesn't work for me, my cost was 9%. 20 into 9 is 1.8. So the maximum loss that you can expect in this strategy is to the tune of that cost that you're paying to of 1.8. So the perception of, you leverage 20, but you may lose 40, 50 is something that we're trying to contain over here, right? So hence the extent of leverage of the portfolio should be not more than 20% of the overall portfolio. So these are the 3 key principles that we keep in mind, before taking out and, going ahead with any leverage strategy. After that, what is this strategy? What is the objective of doing this strategy? The objective is to increase the overall yield of the investment portfolio. Now, how does this strategy work? Client may leverage up to 20% of their investment portfolio by pledging their existing mutual funds, borrowing and investing in the structured product, which is a 5-year structured product. This is done by raising funds at 9% per annum and investing into structures which potentially yields 15.02% per annum, right? So what is the impact of this? The impact is that the strategy generating an absolute return of about 61%, which is net of the leverage cost over a period of 5 years, right? So in this case, if Sensex perform more than 6.5% or higher, you're through, right? Because my structure is not like my mutual fund where I'm depending on the market to grow by 12%. With 6.5%, you are there, right? And what are the historical probability? Like we saw, probability of success is 84% in the product, and probability of break even is almost 94%. Right? Now let's look at the impact of this particular leverage strategy in the portfolio over different time period. If I have to say 5 years, 10 years, 15 years, 20 years, what is the impact of this leverage strategy? So to generate a 14% return, we know the most optimal portfolio comprises of, let's say, 60%, 65% into equity mutual funds, 35% into structures, right? So what does this below table does? The below table highlights ki if I take that 20% exposure, what is the additional value created by leverage in different time frame? So we have taken two portfolios over here. Portfolio 1 without leverage, portfolio 2 with leverage. So 65% in equity mutual funds, 35% in structures, and zero leverage. And similarly, the portfolio 2, 65% in equity mutual funds, 35% in structures, and 20% in leverage. So a 10 crore portfolio with a 14% per annum return, compounding over a period of 5 years will double. 14% doubles your value over a period of 5 years, which is 10 crore becomes 20 crores in the next 5 years without leverage. But if you do leverage, the same 10 crores will become 20.8 crores, which is a 80 lakhs of net impact, additional impact of that 20% leverage. Let's say if somebody were to do another cycle of leverage. So the 10 crore in the next 10 years will become 40 crores, but the same 10 crore will become 43.3 crores, which is a 3.4 crore additional value created by 20% leverage. Now, the interesting point is here. If somebody were to do 3 cycles of leverage, 10 crores without leverage will become 80 crores. But with the 20% exposure to leverage, the 10 crore will become 90 crores, which is a net additional value of 10 crores. So, point being made, today we have put in so much of effort to create that 10 crore portfolio, right? The same 10 crore portfolio with that 20% exposure in the next 15 years can generate equivalent value as an additional value over and above your core portfolio by having that 20% leverage, right? That is the impact of the 20% leverage strategy on the portfolio over 5, 10, 15, and 20 years. Obviously, compounding 20 becomes, in 20 years, it is 28.2 crores. Right? This is the impact of the leverage strategy. Now, let's dive into the math of the strategy. What is this strategy? What is the structured product that we're going to look at, right? And what are the different scenarios of it? This is what the leverage math looks like. So we have taken an example of 1.1 crore, right? Over here, what happens is, as you all know, structured products are like a conditional coupon products. It has a certain condition to give you certain returns, right? What is the condition over here? Tenor remains same. It's a 5-year structured product. What is the condition? The condition is that in the next 5 years, if market grows up by 39% absolute, product delivers a return of 108%, which means 1.1 crore invested will become 2.29 crores. You repay back the principal, you're left with 1.19 crores. That's the profit from the structures now, pure profit. But since you had borrowed that 1.1, there was a cost attached to it. The cost works out to be 52 lakhs over a period of 5 years, cumulative cost. Even if I exclude that cost, net what you take back home for free or the additional return that you ended up making is about 67 lakh rupees. Right? What are the odds of you making that 67 lakh rupees? The odds of us making that 67 lakh rupees is 84%. Right? That's the best case scenario of this strategy. The second scenario is, since there is a cost involved, there has to be a level where the cost has to be recovered. So even if market grows up by 32% in the next 5 years, product delivers 47% return, which means 1.1 will become 1.62. You repay back the principal of 1.1, you're left with 52, and 52 was your cost, so mota moti you are at a break even. Odds of you being at least at break even is 94%. So in a way, on the upside, 94% of the time you at least be at break even or make that additional 67 lakh rupees, because 84 is a subset of 94. Right? On the downside, what is the risk that we are taking? We are taking a 6% probability risk. By that, what we mean is, what if market doesn't grow by 30%? Market's below 30%. Then product does not deliver any return. 1.1 invested, you get back that 1.1, you repay back the principal, but you had paid a cost. So 52 lakhs is the loss, and the loss is extended to the cost that we have ended up paying. Product has an inbuilt feature of principal protection till negative 20%. Right? If market falls below negative 20%, that is where you lose something from the product and you've paid the cost. So there's a double whammy over there. But we are not worried about this situation. Reason being, in the past 25 years, if somebody would be investing every day into these markets, there was not a single 5-year instance where market was below negative 20%. Maximum fall was somewhere in the range of about 19.3 odd percent. Hence, I will use that statement that the loss is to the extent of the cost that you end up paying. This is what the math of the strategies or the complete strategy in a nutshell. But here, everything is in value terms or rupee terms. Nowhere we have computed the IRR of this strategy, right? We can't look at just 67 lakhs ka profit divide by the 52 lakhs of whatever interest cost we'll pay and then compute a CAGR or an IRR. That's not the right way to look at it, because this 52 lakhs is not a bullet payment on day one. This is something that we service every quarter. So on a basis of 1.1 crore, roughly the quarterly interest works out to be say about 2.5 lakh rupees, right? So obviously my cash flow comes into picture, my time value comes into picture. So I'll have to look at the cash flow of this strategy and compute the IRR, right? So what happens is, one second, I'll show you the cash flow as well. This is the cash flow. Standalone IRR of leverage strategy. Let's say if we execute this strategy today, let's on 14th July, right? Here I've put 0, which is on purpose. Why so? Because the 1.1 crore is not something that the investor is paying from his pocket. It is leveraged capital and getting invested, right? The only thing that he's servicing is the 2.5 lakh rupees every quarter, which is the interest cost over the 5-year period. At the end of the 5th year, the profit that you ended up making from the structure was 1.19 crores. It's like a simple, how do I put it? Pardon my language, but it's like a banya hisab. What is going out, what is coming in, right? And then I compute the IRR of this particular cash flow. The X-IRR comes out to 34.2%. That's the standalone IRR of leverage strategy, right? So why such extrapolated IRR? It's like, 1.1 crore invested today has started earning 15% to you over a period of 5 years. But you're only paying to the extent of 52 lakh rupees, and that to spread across 5 years, right? So compounding is in our favor, hence that IRR extrapolates to 34.2%. So this is the standalone IRR of leverage strategy. Now, the thing that I mentioned in the earlier slide was we're going to pledge our existing mutual funds. So how much should we need to pledge, right? 1 second, sorry. So leverage strategy and collateral required and interest payments, right? So security required to be pledged to borrow. For the leverage strategy, we will need to pledge mutual funds to the tune of 2.5x the borrowed amount, which is 40% LTV. So for a 1.1 crore, we'll require to pledge 2.75 crores of mutual funds. The actual requirement is 2.2 only, 50%. However, we're keeping a little higher to absorb any short-term fluctuation. Let's say if you have a case where you've only pledged 2.2 crores and you've taken a loan of 1.1 crores, market corrects by 5%, you will be in a place where you'll have to go back to the client and say, sir, give me another 10 lakhs, another 5 lakhs, another 15 lakhs in order to pledge. To not to be that in that situation, we are taking a higher margin, right? So 2.75 crores, 50%, ideally you get about 1.37 crores, but we'll only take funding of 1.1 crores, right? Like I said, quarterly interest computation. So you saw in the earlier slide, the quarterly interest computation, the cost of borrowing is 9%. So if we borrow 1.1 crore, the quarterly interest works out to be 2.5 lakh rupees. So the total interest cost over a period of 5 years is 52 lakh rupees, right? And lastly, in terms of the taxation, right? The tax implication on this strategy, obviously a very big disclaimer to be consulted with the client CA. Okay. What we have is, as per section 48, the interest paid over the tenor of the loan can be added to the cost of acquisition, and therefore the taxable capital gains will reduce to the extent of the interest paid, which means in our example, 2.29 crores was the maturity of the structure, 1.1 crore was the purchase value, interest total pays was 52 lakhs. So the net taxable gains is 67 lakhs, right? So you can add the interest component to the cost of acquisition and you pay taxes only on the net gains of the strategy and not on the complete gains of the structured product. Because as per section 48, you are allowed to add the cost of the interest expense as the cost of acquisition of that particular capital asset. And since structures are debentures are capital asset, the rule same applies over here. Right? Yeah. And this is nothing but a proposal. Let's say if somebody had a 10 crore portfolio, 2 crores is the maximum so somebody could do, because 20% is the restriction. So the execution plan could be either ways. Either you can, split it across two tranches of 1 crore each, or you can do 2 crores in one shot as well, depending however the appetite of the portfolio is and the client is. Right. Yeah. I think that is more or less I wanted to summarize in terms of what the leverage strategy is.
Right. So, Rahil, I think so we can open the floor for a few questions and then probably we cover the operational part. So,
Yep.
there are a few questions on the Q&A box. So, post-tax returns, what would be the post-tax returns? Because if we consider the interest cost, which is added to the cost of your investments, then
Hmm.
what would be the post-tax number which we are looking at? Because then I think so it makes much more sense as well, right?
Correct. So 67 lakhs is your pre-tax return. Structured products, as you all know, are taxed as per the slab rates, right? As per section 50AA, which was introduced about last to last budget. Irrespective of the tenor in the structured product, it is taxed as per the marginal tax rate. So let's say if it's 30%, so 20 lakhs would be your tax outflow. So 45 lakhs would be your net gains of the leverage strategy. And this 45 lakhs is going to be over and above whatever your portfolio is making for you.
Portfolios. Understood. So still it is much, much better compared to a normal strategy because you're saving on the tax as well because you're paying a lower tax there because the cost is something which can be added to your principal. It's like basically your sort of an indexation sort of benefit where you're
Correct.
basically adding the interest cost to your purchase.
Correct.
Wonderful. Which companies? Yes, Ashish, we will cover that. So basically the NBFC of Anand Rathi, which provides LAS, that company is providing LAS at 9%. So we'll cover this. I think we just first take more questions on the product, and then I think so. Rahil will give a brief on how the operational bit is taken care of. So Deepak, I think so. The question which you had, so the answer is not 1% specifically. I think so. That is something which is covered and specific to last year. So this is of course a 5-year product. This is not a 1-year product. So it's like if you're just looking at last 1 year returns, then structure is still doing better compared to a mutual fund because it is not delivering negative. And your 14% returns will start at a much faster rate compared to same if you do it through mutual funds. So there the structure product uh, capabilities remain the same. It doesn't differ. Even if you invest at a higher level or a lower level, I think so. It doesn't matter. Rahil, if you can give more
So,
color on this,
yeah.
I think so.
Yeah, absolutely. So the reason why we are not choosing mutual funds and choosing structure is that, see, if you're suggesting to borrow and invest, right? Going back and referring to the second principle of leverage, we want, uh, you know, probability of successful outcome should be higher in this strategy, right? Like I said, I gave you some numbers at that point in time. Why not mutual fund is my dependency on the market is very high, right? Structures is lower. So in like let's say in last 1 year, market gave me 5% per annum return, right? My mutual fund will not give me that 15% at that point in time, right? To make good to 15% per annum for both the years in an equity mutual fund, market will have to go up by at least 20-25% for an average to become that 15%. But in the structure, the good part is the first year it's given 5%, and next year it's given me again about 10% also. On an average, I'm still there because my requirement, my dependency was only 5 to 6% in a structured product. So that gives me a peace of mind for us as an advisor and for the client who have invested as well. We don't want them to have that sleepless night saying that, hey, market have not given or markets are negative, because standard deviation of a mutual fund is 12% vis-a-vis your structure is only 4%, right? So to give that comfort in that borrowed capital is where we don't want to play or gamble with that money with a 50% charge.
Absolutely. So, Rahil, there's one more question that so with this, we do we rebalance? So we change the model portfolio every year, right? There are some changes in our equity model portfolio. So we can do this also, right? How do we manage this, the rebalancing?
So once you pledge your mutual funds, yes, the mutual fund units are locked in, right? If you again go back to the strategy, let's say it's 60-40-20 or 65-35-20, irrespective. If I'm doing a 20% leverage, the total mutual fund I'll require 40, right? Or 45 max. Out of my 65, my 45 will be locked in. 20 is always free. If there is any scheme which is non-recommended in that 45, I can pledge any free units from that 20. I can unpledge from the ones which are non-recommended out of that 45, and I can rebalance that. So that is something which is possible.
Yes. So there's one more thing. So although of course SP doesn't has downside protection, so in case the market overall goes down, there would be margin call scenarios, I think, so which you mentioned. So we
That is
also,
like a standard procedure of any loan, not, let's say, not Anand Rathi. Let's say if you take it from somewhere else also, it's your standard loan procedure. It's an RBI guideline. 50% LTV is something which needs to be maintained. And if you don't maintain 50% LTV, if it goes below 50%, 7 working days. In 7 working days, you have to recoup for whatever the shortfall is. If you don't do that, then the NBFC has the right to recover that particular money from the existing mutual funds.
so these are, I think, so standard norms which are there.
Correct.
So the point is liquidity, I think so. The point which he actually asked is that
Okay.
if there is pledge, so there is, you can't redeem. So then liquidity is something which is wrong. But I think so Rahil did mention that we are not pledging the entire amount. We are pledging only the 40%. So still 20% is something, 25% is something which is still there, which can be utilized for his liquidity requirement as well.
Correct.
Right. There is one more question. The tax rate will not be 30%, but in the year of maturity. So what's the highest slab if we take the surcharge as well, Rahil?
34.34%. If I take cess and 10% surcharge, 34.34 would be the highest tax.
34.34 is the highest tax, and it will not be 35. Okay. The minimum size, as Deepak he mentioned, that if it's a 10 crore, then 2 crores is something which we can give. So the single ticket size trade for a leveraged product is 1.1 crore. So that's the ticket size there. Can you please share the extract referred here? So do we have a copy of the extract, Rahil, on the section 48? Any more details? Because I think one of our partners had spoken to his CA and he said there's no such provisions mentioned. If you have more clarity there.
I'll share the extract with you. We have the extract. We'll forward it to Pratik. He can
Yes.
take it, share that with you all.
So in this, I think so, Dinesh, we also spoke to one of our partners who is a CA, and he said this is something which is available. There's just one more clarification, I think so, which was mentioned in the slide as well. That suppose if you are taking the benefit under the housing loan, which is section 24, so you can take the interest credit of 2 lakh rupees. So basically, what this section says is that in this you have taking a benefit of 9 lakhs. But 2 lakhs is something which you're already claiming under section 24. So then you'll be able to claim only 7 lakhs as the benefit and not the 9 lakhs. Correct me if I'm wrong, Rahil. This is what the section is. So if you have an housing loan and if you are claiming the benefit of 2 lakh rupees, then that 2 lakh is something which is deducted and you can still take a benefit of 7 lakhs. So there is one option, please suggest if infra debt AIF better options where returns are around 18 to 20%. Rahil, if you can give more color, I can answer this, but something on this is like if you get these queries on what is instead of this an infra debt or an AIF is a better option.
I don't know which particular AIF or which particular infra debt are we talking about. So I think this is something. So leverage as a strategy is something you usually don't see as a strategy. Somebody, if you want to do leverage, I'm just trying to get into a perspective of leveraging. If you are comparing things, where do you see leveraging? Majority of the time, in terms of capital markets, you will always see leveraging into somebody who's dealing in options. That is where somebody leverages, right? In capital markets, nowhere other anybody leverages. right? So this is not something that we want to do there. This, we don't want to go into that particular zone, because whenever you, I'm sure you all know, right? When you log into your Demat account, the first pop-ups that you get, 9 out of 10, investors have lost their money into options. So we don't want to get into that risky zones. The strategy is completely different. It is a long-term strategy, safer strategy, where client can make that additional 6% spread on their overall strategy, and 1.2% additional return over and above what the core cash component is. That is what our suggestion and recommendation is. We don't want to be over greedy. We don't want to be underexposed that it doesn't make a difference as well. Yeah.
Absolutely. Uh, uh, so I think so, Rahil, if you can just cover a bit on the operational part, is like, I think so there are a lot more questions there. So if you can just cover a bit on there, and then probably we take the rest of the questions. So how this
So,
process works specifically is like
so let's say
the
once you take this once you take this strategy to the client and client has agreed to it, what you will have to do is, first thing first, there are checks and balances. Basically, you have to open a LAS account with ARGFL, right? There's a, just like how you open a Demat account, there's a booklet, if I'm not wrong, or probably it's digital, however the case may be, right? You have to get that booklet signed. You have to set up a LAS account. Along with that, there are list of documents which would be needed, such as KYC documents, ITR of last 2 years, and yeah, I think these are the key documents: ITR and KYC, right? Along with that, there is one more format of Excel wherein you fill in the details of which mutual fund are you going to pledge and how many units, right? That is what something that you have to do. That's your step number one. Step number two, once that loan account is set up, you have to pledge mutual funds. Now, mutual funds can be physical or Demat both. In physical, you have to have that AMC wise letter which has to be signed and submitted to the AMC. That's one way of doing it. Or I think, I don't know whether we can do it online or not. So that's there. Demat, you have only one pledge request form that you need to sign. And then through that, you can pledge the mutual funds. That's your step number two. Step number three is, once these two things are set up, there will be a sanction letter which will be issued from the NBFC to the client directly. From the NBFC to the client registered email ID directly. Client will have to sign that sanction letter and the disbursement letter. There are two letters basically, sanction and disbursement. They'll have to sign those two letters and give that letter back to the NBFC. Once they receive that letters, they will initiate the disbursement. This is the cycle of the operational bit. I'll share the checklist and the process with you in detail, which you can obviously forward to the partners and for their more detailed understanding.
So this generally takes around 7 to 10 days max, right?
Yes, it takes about seven working days, because your physical pledging itself takes about 3 working days.
Okay. So then, yeah, so then it will take 7 to 10 days.
Correct.
So this is something which is given by the ARGFL. The interest rates on mutual fund is 9%. That's the rate which the NBFC is offering. The debit, is it, can we do it through e-mandate from the client's bank account, or
Absolutely.
it's an
We can do
e-mandate?
it via Nash mandate. We can do it by a Nash mandate. And we should do it by a Nash mandate, because why am I saying this is, every 7th of the next quarter is where they'll have to service the interest payment. If they fail to pay on or before 7th, right, then there is something called as DPD, due past date, which gets reported, and the CIBIL score of the clients might get affected. So we don't want to be in that spot. It's better we to have a Nash mandate.
Are there any other charges other than the interest which needs to be paid? Any one-time fee or something which is there, Rahil?
I think for us individual, it's roughly about 1,000 odd rupees. For non-individual, it's about 2,000 rupees. That's what the fees
That's
are.
one time to set up.
Yes.
Okay. Which are the other, any other wealth management companies offering similar leverage product you've heard of?
Not really. No one that we know of.
There's one more question related tax, Rahil, that can we treat this as a business income so interest can be set off as a cost?
So when you do it under a non-individual name, right? There are two ways to treat this interest cost. Either you capitalize, you realize every year, or you capitalize and then you realize at the end when it matures, right? So it depends from business to business what is more prudent for a business to do. But our recommendation is that if at all somebody is doing it for this purpose, at the end of fifth year when he gets that lump sum gains, right, he needs to have that interest cost to set it off against that, or else he'll have to pay taxes on the complete gains because you've utilized that over a period of time.
So it's better to
Capitalize.
capitalize it. Understood. So in the new tax regime, do there any option of taking interest as a cost? So this section, I think so, is there in the new tax regime or the old tax regime as well. So this section is something which I think so you can definitely utilize for this. Please suggest if 5 years fixed for SP or any time. In this, do we give premature exit, Rahil, after 1 year if the client wants to exit? Do we have such option which is there in the normal product which we have in the primary?
So the conditions remains as it is, like a normal structure that we have. Like we say first 365 days is a lock-in, right? But it is advisable to not do it for 1 year. If somebody has a time horizon of 1 year, it is not advisable to do it for 1 year because, as you all know, structures are unlike your equity. They don't fluctuate as your equity mutual funds. You don't see a plus 2%, plus 1%, minus 1% valuation in your structured products. Structured products are like debt, which keeps on accruing like a debt in the portfolio. So you see the compounding effect over a period of time. So minimum investment is something ideally we recommend to stay invested for at least 3 years, at least. And then we can think of. But if somebody needs some money, we'll have to figure out a way how we can facilitate that early exit as well.
Understood. So is this available under strategy? So 50 lakhs, we don't have a different product, ma'am. And even for the secondary, the IRRs are lower. So then basically, I think so the 3 steps which Rahil mentioned, that why this leverage is something which is taken. So your benefit is something which is reduced drastically if we do it at a product where the IRRs are lower. So then it doesn't make much sense. So then it's like you're taking a lot of effort for a very little outcome. So then it doesn't make much sense in getting the leverage strategy for a smaller ticket size and the product where the IRR is lower. So that's there. Can you explain? So I think so taxation he mentioned basically your principle. So what Rahil mentioned, I'll just repeat again that if you invested 1 crore and you're paying 9% as the interest, so 1 crore पे 9 लाख रुपीस जो है जो आप हर साल इंटरेस्ट कॉस्ट ऐड करोगे तो 9 lakhs अगर आप 5 साल के लिए ऐड करते हो तो आपका कॉस्ट ही हो जाता है 1 crore 45 lakhs एंड योर मेच्योरिटी से 210 तो 210 minus 145 the balance 65 is the gains on which you pay tax. So that's how your taxation is reduced, Vikas. Just to give you a simple example, I think so numbers में 52 and 67 है. Just to give you a brief कि भाई हर साल 9 लाख से मैं ऐड कर रहा हूँ तो मेरी इन्वेस्टमेंट की कॉस्ट ही 1 करोड़ 45 लाख हो गई है. And if I gain 210 which is at maturity तो 1 10 तो निकल जाएगा and the balance is something which is the gains on which I pay the tax. As we said, the ARGFL, if we invest in the structured product with Anand Rathi, we get the LAS at 9% on MF. On stocks, the rates are different. It is 10%, but on mutual fund, it is 9%. Partners, just to clarify on that. So for 1.1 crore, yes, the client ticket size is there. So, Vishal, the process is currently offline. If it's online, I think so we can do it faster. The process is there. We are trying to make it online. I think so. But currently, I think so we mentioned the timelines, which are the broader timelines. If we can do faster, of course, we can do faster. But currently, I think so the offline process, which is there, it takes 7 days, 7 working days. So Yogesh, I think so. See, there are multiple products. The objective is really very different here on why we are taking this leverage. See, leverage is something which can be provided on multiple things, right? But the objective here is very different, that in the same existing basket, how we can actually optimize the client's returns by using debt as a strategy, which we all generally, the businessman uses, but how he can effectively use it without compromising much on returns, right? And without impacting his overall journey. So that's the thought process. So it is not a complicated, I think. So it's a much simpler one, because here you have almost a 94% probability of break even or making that 6% returns. This is something which you will not get in any equity linked product. So your AIFs or your PMS or your stocks, there you will not have a 94% probability of making or covering that cost of interest or making 6% additional returns. So I think so that's where structure product is something which is taken for investing the leverage amount and not mutual funds, which Rahil mentioned. There it, I think so it's much more safer. It's like we have to make it much more safer and beneficial for the client, and not just for the sake of it, or that leverage leke hum kuch aur kaam karke just to make it rosy. That's not the purpose. That's the reason I think so debt and structure product specifically was added in this. Rahil, if you want to add more on that.
No, absolutely, you're right. I mean, we want to make it less riskier. We want to make it more successful in nature. We don't want it to be like I said, 50-50% taken. We don't want to gamble with that money. That's the whole point, right?
Absolutely.
If a client is making additional, or just on a lighter note, he's making free money, 67 lakhs rupees or 50 lakh rupees is something which is good enough, right?
Absolutely. So there's one more question. Can we not have a pledge across all consolidated family accounts and disbursement in one member? Is this possible, Rahil?
Yeah, absolutely. That is possible. Just like the concept of joint account, you can have a borrower and a co-borrower, right? So let's say husband has a crore, a wife has crore, and the kid also has 50 lakhs. You can have 2.5 crores all put together, where the husband becomes the primary borrower and he services the interest cost. But mind you, the capitalization of interest cost will be only given to the borrower, main borrower, where the loan has been disbursed. If you pay it from somewhere else account, then you cannot have that set off.
Okay, so only the main borrower will have the benefit of the.
So to answer the question, yes, you can have multiple co-borrowers. I think not more than two is the thing, right? So you can have two co-borrowers put together. You can have that 2.5 crores.
Okay, so that is possible. Can LAS be closed earlier, before 5 years? It's like I can pay the
Absolutely.
money.
You can close the LAS account anytime, as and when, let's say, if a client gets some money, right? You can close down that LAS as early as in then 1 week's time, and so on and so forth. But there is no pre-closure cost in this
No
as well.
pre-closure.
No.
So 1.1 crore leverage on a 3 crore portfolio is 37%. So that is something which is of course higher on. That's something which is not recommended, Dinesh. It's like if it's 37-40%, then we are actually increasing. But then here we can try to look at is the overall wealth of the client, that he has only 3 crores, or 3 crores is mutual funds, and probably something else he has, which is say stocks. And that is something which we can consider and probably start moving, not immediately, but later on. So that's how you can try to put it across, but we don't want to increase the percentage beyond 20%, because that's where the mark is, as I said, right? That we don't want to compromise on the downside as well, because there is a 6% probability that the markets might be 32% or lower. That's where you lose the interest cost. So then, if that allocation is higher, then the loss would be much more for the client, and that is something which would not be.
The idea is we don't want to lock in 100% of the portfolio of any client.
Yes.
Right. So 20% keeps some portion which is open in the overall portfolio. So as and when liquidity is needed, they have that liquidity to service.
Absolutely. So the payout actually, partners on this product is, so this is the Sensex based specifically leverage product, which is a separate product. So the payout is that if you do a 1 crore ticket, then the payout is 3%. And if it's more than 2 crores, then it's 3.5%. That's the payout on this. So it's different from the primary one, slightly different, but that's the payout on the structure product. It's an upfront payout. So it's like whatever trade you do in the month of July, you'll be paid by 15th of August. So that's the payout structure for the leveraged product. There are any more questions, partners? You can put it on the Q&A box, and we'll be happy to take them. I've missed any. Just let me just check. Anything more you can actually highlight, Rahil, that how this concept basically helped in the private wealth business that how you could get more money or something, or how the addressable market basically increased, or how has been your experience? Because this is something which is new for our partners. So if you can just brief more on that.
I'll just give you a background. We have, this is not a new idea. Obviously, we trial and test this, right? Whenever we come out anything in the market, we first try it on our portfolios and then we go out in the market and we do. So, in 2015, we had first done the leverage. So I'll just give you a background. In 2015, we did the leverage that got matured in 19. Then we did second round of leverage that got matured in 22, right? The put together, the successful outcome was almost 98%, right? So 98% is a very good outcome for any pilot testing that one does. So 22 onwards, we not completely went out, but wherever the portfolio is eligible and a portfolio who can take this leverage is where we went out and talk about this leverage. Obviously, it's not a concept that you talk about it then on one go or 5 minutes it's just through and you take it, right? It'll take time to absorb. As an Indian mentality, one would not like to borrow, right? But this is a concept which is difficult to penetrate. Point being made, 22-23, we did 270 crores of leverage. 23-24, we did about 580 crores of leverage, and last financial year we've done about 2000 crores of leverage. So put together, we have total 3000 odd crores of leverage, which is live on the books, right? So it is gaining a momentum over a period of time, and once somebody gets the complete cycle of leverage, it's like, again, on a lighter note, I'm just trying to say कि एक बार खून चख लिया तो then it keeps on going on. So we have a lot of repeat clients who have been doing leverages as well, right? So you have to position it in a way saying that it is not something that we want to be greedy about, right? The immediate reason of one looking at leverage is, okay, I want to make that extra return. Yes, absolutely right. That's the whole purpose of it. But there are so many means and ways one can use leverage. Let's say if a client has set a target that they want to grow money at, let's say 14% or 15%, but you're running short, you're running at 13%. What is it that you can do to bridge the gap? You can use leveraging as a strategy to bridge that gap, right? If somebody has a personal aspiration to create additional kitty, you can use leveraging to create that additional kitty. So I'm just trying to say there are so many means and ways one can talk about leverage in a strategic manner, not like a another additional transaction that we do.
Understood. So yeah, this is one question, Rahil, if you can just answer that, why we've changed to Sensex instead of Nifty. Recently, we've started this Sensex based products from the month of July. So if you can just give more.
So it's an actively diversified management call that we're trying to take now, right? We've always been doing Nifty-based structured product, but if you look at the historical correlation between Nifty and Sensex, it's a 99.9% correlation between Nifty and Sensex. So it's an actively managed, or say active call taken by the management. Did we want to diversify on in terms of the underlying reference index, because structured product as the concept does not give any restriction while designing a product. You can design a product today on Nifty, you can design product on Sensex, you can design product on mid cap, you can design product on a single stock, basket of stocks, you can also design products on commodities such as gold price, silver price, right? But we want to stay in the basket of best companies in India, right? We want to be into something which is like an autocorrective index. There are only two major indexes in India, which is Nifty and Sensex. Nifty we have already been doing, and this is now Sensex that we have started doing it.
Wonderful. So, Rishabh, restructuring, as we mentioned, that we don't lean or pledge the entire portfolio. So it's like 65%, may say almost say 35-40% is something which would be pledged, and the balance 20% would be available, which can be used to realign. So that will not have a problem at all. That is something which would work as is status quo. There would not be much changes there. Liquidity, as Rahil mentioned, it would be similar to what the product is, but we are not looking for liquidity. It's like if the client wants money after 1 year, then this is not something which is recommended at all. But rest remains the same. Interest, as Rahil mentioned, interest would be charged every quarter. Puneet, it would not be yearly, it would be charged quarterly. The minimum ticket size is 1.1 crore. It's a 5-year product. It's not a 3-year product. It's a 5-year product. So that's where the details are. I think so. More or less, we've covered all the questions. So thank you, Rahil, for actually taking us through this leverage strategy. I think so. We understood that why, first of all, why leverage should be there. I think that's the most important part. That why we are adding this, what's the thought process behind this, and what actually it is adding to the overall client's portfolio. We are basically adding a 1% per annum, but in 15 years we are actually getting him more than the principal. So that's where his journey becomes much more faster, smoother. There are tax benefits as well. So that's the other advantage. And 67 lakhs is something which he can make mota moti on a 1 crore, 1.1 crore structure product with 84% probability, 94% probability that he doesn't lose money. So just a 6% probability is there where probably he loses out. But during that time, we all know that very few things will work. So if we are taking this call, then it's a judicious call which we are taking where we are discussing with the client and adding this so that it can add more value to the client. We'll share the presentations. I think so that is something which we already have. So thank you, Rahil. And you want to add anything, and then probably we can close. Yeah.
Pratik, it was a pleasure being, here and talking to you all about the leverage strategy, and happy to answer the questions as well. And if you guys have any more questions, you can all feel free to, connect with Pratik, and we can connect back if need be. Yeah.
Absolutely.
Thank you so
Thank
much.
you. Thank you, Rahil. Thank you, partners, and have a great day.